You've been told that investing is for people with money left over, and you never have money left over, so you don't ever start. I get it. But even starting small on purpose is so much smarter than waiting to start big. By the end of this episode today, you're going to know the exact first 3 steps that you should take to make sure that you can start putting your dollars into the system to start working for you. Welcome to the Net Wealth Nest podcast. So let's talk a little bit about the mindset around investing. Investing, it isn't about picking winners. It's about buying a tiny slice of the whole market and letting time do the work for you. Now, don't get me wrong. Investing, it carries risk, but it's not gambling. And I'm going to give you a really solid example here. The stock market crashed in 1929, and it took 25 years just to get back to even. 25 years. That's the line that scares people out of investing. It's the line that makes the market sound like it's a casino and that your money can come and go that easily. Like you could hand over all your money and maybe you won't see it until your kids are grown up. But here's the problem. While that line is technically true, it is almost completely misleading. So let's set the scene. It's September 1929. The Dow Jones, the granddaddy of all stock market indexes, it peaks at $381. Then the floor falls out. By 1932, the Dow bottoms out at $41. That's a 90% collapse. And if you're just tracking the index number on a chart, you're right. It didn't climb back above $381 until November of 1954. That's the 25 years. And that's the story that most people stop at. But the story only tells you what happened to the number on the chart itself. It doesn't actually tell you what happened to an actual person's money. So here's the thing. We actually ran the numbers so that you could see what it looks like. Now, this is kind of our Invest $50 episode, right? So let's say back in September 1929, right at the peak, right at the worst possible moment to start, somebody puts in $50. And then no market timing, no panic selling, no trying to be a hero. They just keep adding $50 every single month, straight through the crash, straight through the depression, straight through World War II, all the way up to the end of 1955. Here's what actually happens to that money. By the bottom of the crash in July 1932, this is the absolute worst point in market history, 90% drop. They've put in $1,750. It's worth $704. Enough. That hurts. That does not feel good at all. And that's the part that everybody remembers. But let's keep going. By the end of 1936, just 7 years after the peak, not 25, they put in $4,400. It's now worth $8,585. They're already up. They're already positive within 7 years. By the end of World War II, 1945, they've contributed $9,800, and it's worth almost $24,000. By November of 1954, the exact month the headline number finally claws back to its old high, that $381 is the Dow average, this person has put in a little over $15,000. You want to know what it's worth? $85,600. And if you just flash forward to the end of 1955, $15,800 was put in, and it's now worth over $116,000. Quick pause for a second. If anything I've shared so far has hit a nerve, if you're carrying debt you can't seem to shake, or if you haven't started investing yet, or you're just not sure where you actually stand financially, I built something specifically for that. It's called the Financial Pulse Check. It's 2 minutes, 7 questions, and it'll tell you exactly which money habit is costing you the most right now and what to do about it first. It's free. It's at netwealthnest.com/pulse. Or you could just head over to our website, netwealthnest.com, and you'll see the floating bubble. And I'll drop the link in the show notes for you too. But just take it before you forget. One more time, that's at netwealthnest.com/pulse. All right, let's keep going. So which story is true? It took 25 years to recover, or you'd have turned $15,800 into 116 by living through the worst crash in American history and just being consistent through it all. They're actually both true. Just depends on whether you're looking at an index number on the chart or a real person who kept showing up. Now you might ask me, like, how is this possible? You are contributing money during the crash and while the stocks go down. So you're buying those stocks at a cheaper price point. You're not buying them at the $381 peak. You might be buying some at a $200 dip or a $100 dip, or down to where it got all the way to the bottom where it was $40 in that dip. The other thing to keep in mind too is when you're doing this type of investing where you're spreading your money out across an index, or you're buying multiple tiny little fragments of companies across a larger portfolio, you are also getting back dividends in there. Now, a dividend is when a company turns a quarter and they say, based on our profit, we're going to give a little bit of our profit back to those individuals that hold shares in us. But those dividends typically are automatically reinvested in that same stock fund that you're doing. That's kind of the default of what most people go after, is they continue to reinvest those dividends, and that helps speed up the compound growth calculator for you. Now, let's talk about the gambling comparison. And this is the part I really want you to sit with. People, they'll drop $50 at a casino table, blackjack, roulette, whatever, without even blinking, fully knowing the odds are actually built against them. The casinos have developed these games so that the longer you play over time, you're going to lose. But those same people get nervous about putting $50 a month into an index fund because the market's riskier. What if it crashes? And again, this is the difference. A casino, it's designed so that the longer you play, the more certain it is that you lose. The stock market, historically, over long periods, it's actually the opposite. You are playing the role of the house in that situation. The longer you stay in it, the odds tilt better in your favor. Time isn't the enemy of your money in the market. Time is the actual entire engine. The 1929 crash wasn't just the worst crash in US history. It was accompanied by a full-blown depression, massive unemployment, bank failures, all of it. And even that didn't wreck a disciplined $50 a month investor. It just made the story that much more dramatic. So the next time somebody tells you that the market's basically gambling, tell them this story. Use these numbers. Tell them about somebody in 1929 that could figure out how to put $50 away a month, what it would turn into over those 25 years, a 90% growth return. When you look at the 15,000 that they would have ended up putting in versus the 116,000 that they would walk away with. One key here, the wealthy, they start before they feel perfectly ready. The habit matters more than the amount. That $50, that routine always beats $5,000 that never repeats. Okay, so let's talk about 3 things that you can do to make sure this happens and it becomes a reality. The first one, build your runway. Make sure that the $50 you invest doesn't become $50 you need next week. So having a small starter emergency fund, a buffer fund, any of that is so important. Remember, time is your best friend here, and pulling money out so it can't capture that time is the absolute worst thing you could do. Also, if you're not capturing any of your 401k match before you start to build this, make sure you're doing that. That's a guaranteed return that, quite honestly, no brokerage can actually beat. And then as you're starting to set up this account, pick where that $50 comes from on purpose. Maybe it's a skipped recurring expense that you currently don't need. Make sure it's not a whatever's left, because more often than not, people will spend through and there's usually nothing left. Okay, step number 2, the what. Fractional shares mean $50 can buy a piece of a fund that would otherwise cost hundreds or maybe even thousands. You're no longer priced out. And so our recommendation is always start with a broad, low-cost index fund rather than individual stocks. That way you own a slice of hundreds of companies at once. Also watch your expense ratio. A low fee, so a fraction of a percent, keeps so much more of your growth. This is a wealthy people habit that most beginners don't even think about. And it can lead down the road, I'm talking 10, 20, 30 years down the road, to hundreds of thousands of dollars of lost growth by having high fees. One example, and probably the most popular one out there, Vanguard, which is a brokerage company. You can go online, set up a free account right now if you wanted to. They offer a index fund called the VOO, VOO, and it is basically a index fund that mimics the S&P 500. The S&P 500, if you're not aware, is a collection of companies, the top 500 companies in the United States, and has consistently had good growth over long-term periods of time. So it's one that's very popular that a lot of people like to invest in, especially if they can do it in an index fund at a low cost. Vanguard offers this where you need $1 to start, and you can start investing that into their index fund, and the cost on it is 0.03%. That is a tiny, tiny amount of cost. It's probably one of the best cost ratios that you can find on planet Earth right now. And so this would be something that is easy, that if you had 10, 20, or like we're encouraging $50 a month to invest, you could invest starting tomorrow in Vanguard's VOO fund and mimic the stock market index of the S&P 500. Okay, so step number 3, and this is a little bit of a wealthy person reframe here. Automate this. Automating and not having to remember when to turn in your $50 or repeating the deposit is a huge win. It's similar to what you do with anything else that comes out of your check. Think of like your healthcare that comes out of your check every month, or if you're already doing your 401k, you're seeing that hit automatically. You don't have to do anything about it. It fires every single pay period or every single month automatically for you. Do the same thing with this. You need to make sure that you have that buffer and you've set up your runway like we talked about in step 1 here. So you don't need to withdraw that money back out, or you don't overextend yourself by doing this. And again, that's where it's start wherever you need to start. Starting small is okay. There's nothing wrong with that. If that's $10 a month, that's better than $0 a month. You can always move that amount up. And that's another thing that wealth builders consistently do year in and year out, is they continue to move the amount higher. So think about when you get like a raise as an example. Maybe you get a 2 or 3 or 4% raise. Figuring out what that dollar amount is and then taking a percentage of that and moving it into this is crucial. Now, we can encourage you to do it one of 2 ways. Maybe you continue to bump up your 401k, or maybe you're doing your secondary investing outside of your 401k. It's up to you how you want to do it. Again, personal finance is personal, but you should be continuing to try to move that dollar amount in an investment account up every single year. And if you could do it more frequently than that, even better. But understanding where that money is going and how that money will impact you is paramount. Just remember, the real win isn't the $50. It's the streak of consistently investing over years and allowing it to compound, taking advantage of that time. Once you set all this up, don't check this stuff daily. Boring and automatic is the strategy here. Those who continuously check on what they're looking at are invested in what the growth was this week versus last week and all that. That's not what you're looking for. Remember the 1929 and how far it dipped. You don't need to worry about that. You need to worry about continuously investing over time and seeing if you can move the needle higher and higher. This is where the accountability shows up. Most people understand this, know they should be investing, know they should be doing it every single month, and not stopping when life gets loud or messy. If you're struggling with this, this is what we're about. Come see us so we can help you, whether it be in our coaching or community platforms. All right, let's go over the recap. Understand that investing, while it has risk, it's not the same as gambling. 1929 story, that's all you need to know. First part, make sure you have a buffer, you're grabbing your match, and you're making your runway. Second, low-cost index funds with fractional shares, that's where you want to live. Third, automate and repeat. The market has never been a members-only club. You just needed these 3 steps without all the jargon and all the other junk with it. I hope this was helpful. If it was, make sure you are subscribing to our YouTube channel, liking, and leaving reviews on our podcast. Any questions you might have, toss them in the comment section. I answer them all personally. Thanks for joining today for Net Wealth Nest Podcast. My name's Jim. Bye, everybody. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.